So, David, since we last spoke, we have had a number of conversations about the theme of data centers and how it's impacting power demand in the US. For anyone who's not following the space, data centers consume a tremendous amount of electric power, and all the hyperscalers and many others are trying to build them as quickly as they can.
And really what they do is they build a portfolio, they stick it in the queue, and maybe they build 20% of what they proposed, right? Maybe they build 40%, maybe they be 80%, but they never build 100%. So, and what they're trying to do is flip the project to somebody else, right? And so that's how a lot of these developers make a lot of money, is you get site control and you market that this is the greatest site for solar, and utility company should have this. It is a much better one than what you would do if you go out and find it yourself. And so then I flip these projects to larger entities with lower capital cost. And you're seeing that in the data center space. And so when you look at this proposed amount of load, because a lot of people, what they'll do is they'll graph basically this proposal load. And I think I brought a graph. We could bring it up right now. I think it's a good time. So at SynMax, we basically have already tackled the power project uncertainty by doing a weekly satellite photo imaging of proposed power projects. So we have a platform that I developed, which is called Vulcan. And Vulcan basically says, okay, I'm going to take a weekly satellite image of your location, and I'm going to tell my clients two important dates. Number one, land clearing, and number two, first structure.
The best performing commodity being gold is not a good thing. And the worst performing commodity being crude oil is not a good thing on a global basis. From a global standpoint, looking at commodities that are global, we see a clear deflationary trajectory. That gold to crude oil ratio takes about 55 barrels of WTI for one ounce of gold. Is the highest if you go back 100 years. At the end of year base, it's probably the highest, near the highest ever.
All right, it looks like we've got a quorum. So good morning, good afternoon, everyone. This is Rob Barnett, and I would like to welcome you to today's in-person BI Energy Exchange. We have a guest this week, David Bellman, who's joined us before. He works at SynMax and other places as well. We had a fun conversation with him in January, and feedback was very good, so we wanted to have him back again. And Mike McGlone is a regular here on the call. I think you all know him, and hopefully the discussion today will be quite enlightening. We're in our Miami office, so if you're based in Miami and you want to say hello, just shoot me an IB. Okay, so David, since we last spoke, we have had a number of conversations about the theme of data centers and how it's impacting power demand in the US. For anyone who's not following the space, data centers consume a tremendous amount of electric power, and all the hyperscalers and many others are trying to build them as quickly as they can. And we're seeing a lot of constraints here in the US, where I think the companies are struggling to find the necessary electrons to build what they want to build. So I'm curious, given where you sit, kind of how you're thinking about this. And I think you're also trying to apply some very interesting data techniques to think about this problem as well.
Yeah, so what's very interesting about data centers, it's kind of analogous to renewables. So what do I mean by that? In the renewable space, you have developers that come out and they actually, get site control, and they say, oh, we're going to build this solar, we're going to build this wind, we're going to build this battery, we're going to do all this. And really what they do is they build a portfolio, they stick it in the queue, and maybe they build 20% of what they proposed, right? Maybe they build 40%, maybe they be 80%, but they never build 100%. So, and what they're trying to do is flip the project to somebody else. right? And so that's how a lot of these developers make a lot of money is you get site control and you market that this is the greatest site for solar, and you utility company should have this. It is a much better one than what you would do if you go out and find it yourself. And so then I flip these projects to larger entities with lower capital cost. And you're seeing that in the data center space. And so when you look at this proposed amount of load, because a lot of people, what they'll do is they'll graph basically this proposal load. And I think I brought a graph. We could bring it up right now. I think it's a good time. So at SynMax, we basically have already tackled the power project uncertainty by doing a weekly satellite photo imaging of proposed power projects. So we have a platform that I developed, which is called Vulcan. And Vulcan basically says, okay, I'm going to take a weekly satellite image of your location, and I'm going to tell my clients two important dates. Number one, land clearing, and number two, first structure. So we do in Vulcan is that every week we take a picture of projects, and we basically can conclude if that project is real, right? Because if it hasn't land cleared, then there's hardly any skin in the game. When it is land cleared, there's a little skin in the game. When they put the first structure in, now you know that they at least paid for engineering, planning, and so there's real skin in the game. And from there, when you get the first structure, you can actually estimate the earliest online date with 99% certainty. This is not a guessing game. It's not a black box. If you can go find historical satellite photos of when the first structure was up and when the project got completed. In fact, last discussion we had was how fast do plants get built, and we noted that the fastest ones that we've ever seen is like a solar plant for 210 days, where we saw the first structure and then we saw the completion in 210 days. So if you know when the first structure is, you can guesstimate the earliest online date with 99% certainty. You can guess the average online date with some probability, etc. So we apply that same methodology that we did for the generation space. And right now we're monitoring 216 gigawatts of projects in the US. And we said, okay, we want to do the same concept with data center. The question was, okay, where do I get all this GPS coordinates of all these data centers? We reached out and we have a partnership with IRR. So IRR does outages and stuff like that, but they also have started tracking data centers. And so what we see in this chart is two things, and I made it historical. So this is from the IRR database. We can see how data centers are being built in historical time period. You can see that they were barely building a gigawatt a year. Then all of a sudden, 2023, 24, they're at 5 gigawatts. And now they expect in 2 years to be at 6 times that. And remember, they never did that. This is history. This is not like making up stuff. So now we see the future. Okay. So let me give you a context of what we're seeing here. So the blue represents what we're not taking satellite images of yet. And we may never take satellite images of those because those are typically smaller projects, or they're in urban areas where you can't really see construction, right? So they're expanding an existing data center in an urban area. You can't really see construction. The red represents, we took a satellite image of that project and we have confirmed that there are either land cleared or have a first structure up. So that's what the red represents. The green represents, we took a picture and there's nothing going on. All right, so you can see in 2026, you've got like 8 gigawatts of nothing going on these proposed projects. The odds, and by the way, to build a data center outside Elon Musk Memphis facility, it's really a year. It really takes a year from first structure, and that's earliest, right? Super early would be like an Elon Musk time period, but we didn't want to use that as the benchmark, right? I mean, if you want to be Elon Musk, that's why I would say maybe for data centers, 98% chance that you can be earlier than the earliest online date. But that's what you're seeing here. And then we have a little small segment called the teal color, and that's called identified. And what that means is this product, by the way, is 4 weeks old. So in 4 weeks, I came from 0 gigawatt coverage to 90 gigawatts coverage. Okay, so someone has very tired eyes because they're looking at weekly satellite photos of all these projects. I think it's 500-ish or so, something like that. So his eyes are like,
How much is the confirmed across 2025, 2026, 2027? That looks like probably 15 to 20 gigawatts that you're tracking, that you're actually seeing where they're moving dirt on the ground.
mm-hmm.
And I think roughly we've got like whatever 22 gigawatts of data center capacity in the ground already. So it looks like you're confirmed on a doubling of the next couple of years or something like that. And then you've got a lot of uncertainty where you just have no confirmation of
correct
of dirt being moved.
And then the other thing is to realize the red does not mean it actually, like a lot of that red in 2025 is no way going to get built in 2025. I could tell you because I know when they put their first structure up.
Yeah.
Right. So I can identify at least 2 gigawatts of 2025 that's not going to meet 2025.
But it's probably coming in 2026 or 2027.
Oh yeah, that's yeah. So there's some delays. There's another thing that's we did a weekly report for our clients last week where we looked at a Google facility, and we looked at that Google facility and we said, and it was this Council Bluff, I think was the example, and they have a 3-unit expansion, and luckily for us, they had a high res in March of 2025 Google Earth. And so we can clearly see where the parking lot was. In the expansion area where the parking lot was, there was still hardly any cars in less resolution, but you could see the color differential to see where a car is, because you know that's a parking lot. You can identify that parking lot, number one, isn't really full. Number two, they seem to be still doing construction in DC3, which is the other expansion. So our conclusion is they may have finished the construction, but we don't believe they energized it yet, because you can compare it to the existing parking lot of the existing center, and that parking lot's really full. Now, maybe they have some sort of tram that goes from there to there, but I doubt it. And so that's one of those indications that are interesting about data centers, is that they may actually finish construction, but they may not energize it right away.
So, all right, Mike, I want to bring you into the conversation. So very interesting data set, David. And I'm curious, Mike, these are very big numbers, and a big one implication is that we're probably going to need a lot of power to supply these things. We've talked about the potential for some pretty substantive gas demand numbers to come out of this build out. And so, how do you think this falls into the gas balance here in America? Do we still have tons of available cheap shale natural gas, and this isn't going to move the needle much? How do you think about something like this?
This year's a big test. Because I look over at first, I start with the first gas contract that really is significant is the January 26 contract. It's traded at $5. And the front contract is $3.40. So it's already priced for cold winter and lots of demand. Because for 10 years before Russia's invasion of Ukraine, gas barely stayed. Every time it went above 5, all that supply came back. And once it dropped below 4, the supply diminished and demand picked up. And now it's changing. We had a colder than normal winter. It's pumped gas up. Gas is coming back, but this is why it's the key year. The market's already priced for a cold winter. It's priced for a lot of demand. It's not priced for that supply to come back on, but I love checking with Vince Piazza, our colleague's data, and he usually shows, I didn't check lately, but typically we'll see how that supply is coming on. So this year's a key test, and my rule is never underestimate elasticity of supply, particularly now we have a president who's way motivated to cut back on regulations, make sure the supply comes back on. So if we get all the demand and we get a colder than normal winter, $5 might be not justified. Otherwise, that Jan contract, I think, is going to head lower.
Okay, so how about you, David? All right, you've got all this capacity coming online, potentially. Even if you take your projection, cut it in half, right? They're still pretty big numbers. And so, what's your sense? What kind of electrons are going to fill the gap on all this capacity getting built, and or what's your read into the sort of commodity side of it?
Well, I think so. If we're reading the commodity side plus looking at futures curve, right? The issue when everyone believes something, the odds of it coming out to happen is very low.
Quoted Benjamin Disraeli.
So you have the regulators at ERCOT, the ERCOT administration, they came out and said, oh, their reserve margins is going to get tight. All the institutions that actually do manage these issues are concerned about the issues. So that means that like they're not doing nothing about it, right? So when that happens, the odds of it being solved is increasing exponential. Like big dislocations is because no one's prepared, right? So like the Ukraine war or Winter Storm Uri, it's something that no one's predicting, and that's what causes huge price spikes. But if everyone knows, oh, we're going to have a lot of demand, we're going to have problems, we need to get the supply up, the incentive to make sure it doesn't happen is now known, right? And so I think you'll see some of that. I think what will happen is a lot of the grid operators will probably push back on those numbers that you saw there. And it's like a chicken and egg. Maybe that's why they have that portfolio approach, right? So I suspect certain data center developers have submitted 3 projects in one ISO, 3 projects in another ISO, 3 projects in another ISO, and they're probably only going to build 3. So 9 out of the 3 out of the 9 is going to get built, but you don't know where, right? And it's a risk mitigation because it's almost risk mitigating because of their actions. Because the ISOs are going to go, hold on, this is too much load. We're going to only let certain projects come through. And then all of a sudden, well, then they can justify why they did 9. Right? But the problem with when you did 9 is that everyone here is so unprepared for 9. If 9 actually gets built, it's probably not going to work. But they did 9 because they know they're not going to build 9. So you have this issue here. So I think the other thing that I think we need to realize is obviously there's a big trend for behind the meter. So some data centers think they can just be off grid and they can come online sooner. You had that Siemens Eaton deal and says, oh yeah, if you do our deal and you put gas generation behind the fence, you can come online 2 years earlier than anyone else, right? Well, you're going to lose a lot of grid connectivity. The grid is still valuable at some level, right? Even in high demand time periods, if you really think about our utilization of our grid, that's why you can expand, is because we have reserve margins and you don't actually use load all the time, right? I mean, that's just a fact, right? We have a curve of demand and you build for the peak. That means you're not operating efficiently. So I think there's some room to add this load. There is some room to tell people who are flexible to be more flexible. I think that's a big thing. I think that's a huge missing signal. I think obviously some of the in that chart, number one, let me clarify. The chart was US only. I think there's like maybe 1 or 2 Canadian and Mexican projects, but it's mainly US. So you're going to have a blend of achieving that chart. Number one, the chart is in excess. So that reduces it, let's say 50%. Okay, we'll go with that number. Maybe it even reduces it more than that, but let's go with 50%. Then the next question is, okay, how many of those are going to do like bring your own generation? Let's just say 10%, right? So now we're down to 40% left. Then we say, how many of those can actually get on and get a new connection, greenfield connection, get it all approved? Let's say 50% of the 40%. So now you're down to 20%. And then you say, well, if you can't get it connected and you can't get behind the meter thing, or you don't feel comfortable with it, what's my next alternative? There is a next alternative. Most people don't realize it, and they skip this in their forecasting. So Mike here owns a factory. Mike here makes widgets, and he's making, maybe 10, 15% return on investment. He's doing a good job, and he's got a load of 400 megawatts, and everyone loves his widget. I'm one of the hyperscalers. I'm like, what is he paying? Here, Mike, I'll give you X billion dollars. I want your factory. I want your interconnection. It's really all I care about. You can take your IP and you can go make your widget in Mexico, Canada. Just let me have this. And there's a number that Mike's going to go, I'm ready. Yeah. And so now, did the load increase in the system in this maneuver?
No.
Correct. So I think there's that opportunity.
So yeah, maybe some rough numbers here, because I think like a 1 gigawatt data center, you're talking kind of 20 billion range plus. And so I think like one thing that's interesting here, that's on the CapEx, all the GPUs you're buying and whatnot. And I think one thing that's interesting that maybe is a potential opportunity here is that most of the hyperscalers are generally willing to pay a lot more than the prevailing rate for
a lot
power.
More than Mike.
Yeah, so that's why your scenario works. But do you have a sense, what's I know you've already told me numbers in the past, but what's your sense on what hyperscalers would be willing to pay for electrons?
Well, I mean, anyone that has a cash flow model can run this, right? So you can look at Amazon, go find out what's their latest H100. Last time I looked, which is a year ago, was $5. I'm sure it's gone down now. I'd be shocked if it's not like $3.50 or $4. But you can then reverse engineer how many watts that chip takes per hour, add 50% to that. That's the total hour. And then, sit there and say, okay, let's say the break even now is, I don't know, maybe $2,000 a megawatt hour. It used to be $3,000 at $5. So I'm trying to recompute the math in my head, but their break even cost is so high. But now remember, they had to plop down between 20 to $40 billion for that 1 gigawatt, right? So I think the number is really 20,000 to 50,000. It really is that range, because once you get smaller, let's say you build a 20 megawatt versus a gigawatt. The reason why I'm giving you the 20,000 because you went gigawatt. But if you're at that 100 megawatt size or something like that, I think you're north of the $30,000 a megawatt. But the range is between $20,000 to $50,000 a megawatt of your all-in cost from, and I would say maybe 10 to 20% is the construction cost, and 70 is just the GPUs, right? And remember, these GPUs are depreciating assets, right? The H100 isn't. That's why I said it's probably much less now, because it's been 6-7 months since we looked at it, right? And I'm sure there's the H200 or the Blackwell that's coming out. So there's always something new that's coming up, and so that pushes it down. So you could just put in a cash flow model. Hey, I spent $20 billion, and I make a margin. And by the way, at $5 an hour, even if I spent $20 billion, I think that's under 3-year payback. That's how crazy it is.
But there's also why they're sort of relatively price agnostic on the power. They'll pay for anybody who's got electrons as sort of generally above market rate. There's some of the behind the meter conversations actually about gas. So, there's actually like direct gas playing into this. But Mike, let's broaden out a little bit more here. I know you've just put out your kind of 2H outlook for energy and commodities. So, maybe moving away from just like the pure data center conversation here, give us a sense of kind of how this all fits into how you're looking through the rest of this year and into 2026.
The best performing commodity being gold is not a good thing. And the worst performing commodity being crude oil is not a good thing on a global basis. From a global standpoint, looking at commodities that are global, we see a clear deflationary trajectory. That gold to crude oil ratio takes about 55 barrels of WTI for one ounce of gold is the highest if you go back 100 years, at the end of year base, it's probably the highest, near the highest ever. I think you can go back to 1934, we have that data. So if we don't do something soon where we can get some demand pull for crude oil and something to push gold lower, it's the deflationary forces that are very scary from commodities overall. So I look at this is the world facing 15% tariffs from the world's largest importer on average, which is Bloomberg Economics estimate. And Trump came in with pre-existing trends in his favor. Lower energy prices were already heading lower, and the rest of the world was already tilting lower. This is the case. So the way I look at commodities for the end of the year now is we absolutely have to have copper continue going higher. Now, U.S. copper is up 20% for one reason. It's facing tariffs. It's not a good sign. It's not a reason you want to buy copper. And you look at futures, on a one-year basis, massive selling in futures. Just they're down, open interest is down 30%. So people are not buying into this. So the way I see this playing out is by the end of the year, for these deflationary forces not to accelerate, natural gas has to stay up, copper has to stay up, and treasury and government yields in China at 1.7%, 10-year notes probably have to start going up, yet they're all heading lower. So to me, the big trade is that the US stock market maybe drops 10%. Oh gosh, God help us. It's up 100% since in 2019. That's a severe deflationary domino effect. And I think it's kicking in. And that's what I see from gold rallying, crude oil going down. So that's why I have that issue with natural gas. As long as we don't have a recession, yeah, the demand will be pulled. We have, data centers and everything. But overall, natural gas typically goes down in recessions. Crude oil collapses in recession. It's already heading that way. So something has to stop this. And the number one force is U.S. stock market has to go up. That's why I think the risk is inordinate, that we just have a normal deflationary cycle from the inflation we got to the peak in 2022, which has always happened in history. So I'll end with this. The two key examples in history are 1930s in US, after the stock market reached 2 times market cap to GDP, and 1990s in Japan, after the Japan market did the same thing. So that to me is what gold's picking up in versus commodities.
Yeah, very interesting. So, all right, Dave, you think a lot about some of the more macro issues, give us your read on sort of gas and energy commodities here. I feel like you always default to fundamentals, but what do you read on this?
So I'm gonna respond to Mike, because Mike said some interesting things. I think once again, I think we had the same discussion 4 months ago. It's very scary to say it's different this time. And so you have to have reasons when you say it's different this time. I think if you look at M2, the money supply, that's quite scary. When you look at that 25% of our expenses is for interest payment, that's scary. So I think because of those factors, that's why it's different this time. And then you and I were just on a conversation talking about peak oil in US in 2005. So it kind of makes sense that you would have a deflationary or a downward fundamental pressure on oil. While maybe gold can go up or any other assets, we won't talk about the one that starts with the letter B, but those type of assets can go up because the money supply, you have no choice. Right? The big, better bill, whatever it is, it's just spend more. And I don't see any country in the global world actually managing their fiscal responsibility well. Outside maybe Argentina now, which is funny, right?
That's ironic.
It is, right? I mean, that's it.
Yeah.
It's kind of
so the question is, how much is that priced at? Because that's one thing I really enjoy now compared to a year ago. The narrative of the unstoppable US deficit was just kind of trickling. Now it's in your face everywhere. It's wonderful. That's the only way you solve it in a problem. A country like this has tremendous self-correcting mechanisms. We beat ourselves up and we'll figure it out. A lot of that's already priced in, I think, in gold. That's my point. That's why I think gold's continuing to rally. But we have to mention the B word, because Bitcoin is one of the best leading indicators on the planet. And one thing as a commodity standpoint, I cannot ignore is that Bitcoin to gold ratio. Right now, it takes about 31 ounces of gold per one Bitcoin. It's the same as 2021. That big pump, despite all this hype of this highly speculative digital asset and our government switching favor toward, the rock is still beating it, or at least unchanged. So I'm really concerned the rock is telling us something. And central banks are buying rocks. China, Poland, they're not stopping. There's a headline on the Bloomberg today, which I look at today as what stops it. Usually when I see that, it means it might be a peak, but that's why I have to tilt over. One thing that has to continue going up for us to avoid deflation that's happening in China, Europe, and most of the rest of the world is the US stock market. And one of the best leading indicators is Bitcoin. Just looking at that Bitcoin gold ratio, it's a good leading indicator. And so I'll end with this. May 22nd may go down in history, and I hope not, because that was the day that the long bond, the Treasury long bond 30-year reached 5.15%, and Bitcoin reached an all-time high at 112,000. The fact that these two assets are in the same chart syndrome is really scary to me. So what it means to me is for all this to kind of tilt over to that deflation is for these there's only 16 million, by the way, cryptocurrencies. No issue there with supply. For some of these highly speculative digital assets, just to give back some of that. And that's exactly what happened with the dot-com bubble. It burst, and what happened in 1929 and 1989 in Japan. So that's what I'm seeing from gold. That's what, to me, gold's figuring out. And what's one of the things, you hope you're wrong, but what's the optionality this year? It's so assumed that completely priced in that Bitcoin's going to go up that I look at it as an option trader. Okay, then I'll be putting on some puts on that just in case it goes down because the dominoes tumble.
Here's a question for both of you. So in a lot of contexts, historically, commodities are like a good inflation hedge, right? And I know you're talking a lot about deflation, but if the government's going to continue to spend money like there's no tomorrow, that is somewhat inflationary typically. So, what happens if there is inflation? What happens with commodities generally? Energy, oil, gas.
Well, I mean, you're seeing it in combined cycle pricing, right? I mean, I think that's a shock to all of us in power. I mean, we go back 20 years, you and I were arguing over combined cycle builds, I think, and coal, and we're like at what, $800, $1,200 a kW, and we were arguing over how we were going to do this thing, and now it's like $2,400 a kW. Inflation, right? And this was like, even 5 years ago, you wouldn't say that it was $2,000 a kW, right? So those capital costs are going to show up, particularly if you believe that gas is still roughly the marginal molecule or electron, right? That is required to set the price, maybe 60 to 80% of the time. Then we got problems, right? Because you're going to have to spend $2,400 a kW, which will then change your, you could run that through a LCOE and you'll get a new number. And it's certainly not $60 and $70 power anymore, right? That's not your base power price anymore if you believe the $2,400 a kW combined cycle bill.
Right. Well, wholesale power markets, many of them are higher than that anyway already right now. So
yeah, but this is that long-term view that you can always get. If you look, by the way, if you look at the forward curve, you're roughly seeing $60 power, right? And I think that's because they rationalize, you could just fill it in with gas. But if the gas is no longer $60 power, then how do you get there?
Yeah, maybe one last idea, because we're a little bit over on time and I want to be respectful here. Some questions that came in, by the way, just we'll follow up. Anyone who's on, I'll share the chart that David provided. But conceptually here, one thing that hasn't come out of this conversation is that this idea of like a bifurcated market, right? So we have like this incredible benefit of cheap natural gas here in the US. Most of the world pays a lot more for their gas molecules. And I wonder if, because of LNG, because of growing data center demand, does the US gas market have to calibrate higher given where the rest of the world is, where, given growing demand, or do we just continue to get to benefit from our low cost resource? So conceptual question, we'll come to you first. And
yeah, so we had a discussion last night in dinner, and I think at some level it becomes a policy mistake to send out feedstock that you can use in your own country to create economic multipliers
Good point.
at some point. I don't know what the point is. Is it 16 BCF a day? Is it 25 BCF a day? Is it, you know, I think it's under 50%. So let's say your demand is X and you're sending out 50% to the world market, which is way higher. That eventually causes your customers in your own country to pay that higher rate. I mean, that's, and all of a sudden you end up like a Middle East producing country where you're letting go something and someone else is taking the economic multiplier, meaning they're refining the product, creating a more valuable, useful product for the end user. The end user is where they can pay the premium. And so that would be a huge concern. I mean, so one thing that we do at Synmax is we do track LNG flows. I'm building a flow model that kind of can forecast where all these flows are going. And the question is, you know, as you point out, can the U.S. continue to export and not hurt itself? That's a concern to me.
But hurt itself in the future, not. I mean,
yeah, right now they're
like now
having fun.
Yeah,
but imagine if you kept on telling the country, hey, look, gas is forever $3. Let's just go with that assumption. Then some chemical company is going to go, all right, I think I could put down $1 billion and build some fertilizer plant here, and I think I can calculate all these margins here. I'll start selling it to South America, whatever.
That price.
Yeah, I think I could do that, right? But if you tell them, oh, you know what, this thing could easily double because we're sending 20 BCF a day, and the Europeans are paying $16 MMBTU, and you're sitting here at $3. I mean, that's not going to work, right? That price has to go up because every molecule of gas you want to send to a $16 market.
So let's look at the facts of gas real quick. Go ahead.
Actually, I got to follow up. I have just like a real conceptual question that I've always been curious about. And you're hitting it here. With coal, you often would see companies ink 5-year, 10-year contracts. Why has that never happened in the gas world? Because, you know, one way to sort of take away that risk would be a long-term contract. Why don't we see more of that?
I can answer that. It's actually pretty easy because coal has varying qualities. So the unique thing about natural gas molecules, the same natural gas molecule here across the world, you know, it's CH4. It is consistent. You don't have to deal with metallurgical chemical compounds. You don't have to deal with malleability, hardness. So that's kind of why coal contracts are extended at long time periods, because you actually you can't just substitute so easily.
Okay. Yeah. So first of all, we only export about 20% of our gas, 10% through LNG. So maybe 5 years from now, it'll be 15% through LNG. So I'm not worried about that. Just imagine how much technology can come on in the next 5 years to create more gas. Imagine if prices go up enough, New York State's incentivized to open up, not just New York State, plenty of other states. So I'd like to start out with the basis for all commodities are the grains. In this country, we export about 40 to 45% of corn and soybeans. If we do not do that, prices would collapse. The biggest problem right now is keeping prices up. They're at or below the cost of production, partly because massive supplies coming out of Brazil and South America, partly in the back of that pump, the prices in 2022, and technology. Superabundance is overtaking commodities. Grains, if we don't get a bad growing case, a drought this year, corn and soybeans will just go down another 5, 10, 20%. We can't do anything about it. Massive abundance. You trickle that to the other commodities. Same thing's happening in crude oil. We create more, we use less every day. Rapidly advancing technology. The U.S. exports 4 to 5 million barrels a day. With Canada, 6 million barrels a day. When we peaked in 2008, we're importing 11 to 12 million barrels a day. Superabundance is kicking in there. So to me, that's the key thing to remember in commodities. If you want to invest in commodities, stick with the metals. Gold's the best one. The ones that can be stored easy, they're harder to produce, there's less elasticity, and anything else, go with the equities because they create that superabundance you're talking about. But overall, that's the trend. And particularly, this is on the back, we're in a cycle now, we're in the back of that big pump and prices were steady lower. Natural gas went from 10 to 1.5, now it's stuck, right? Crude oil still heading towards 40, in my view. It's done it every single time for the last 20 years. It has to get below the cost of production to shut that off and reset. And that's before we get to this global recession, which we're way overdue for. So this to me is the trend. And that's what I think gold's picking up on. But it's because of people like you, smart people like you, creating more with less every day that it's just the thing. Remember about commodities is that book Superabundance. There's another book called Abundance. There's another one called Material World. There's dozens of them. Just point out, we create like lithium. It's so material, so readily available in the crust. We just have to get it. So I'm not worried about it. Natural gas is a short term, and don't underestimate the power of elasticity from price. Prices pop up a little bit. We cut off the demand and increase supply.
Okay, guys, this has been fun. I think we could keep going, but we are already quite over our time here. So we'll leave it there, and we'll have to just come back together and revisit some of these questions in the future. Thanks everyone for listening. Again, we will follow up and send out the slide that we showed from David's work at SynMax. And thanks for coming to Miami to chat with us. It's always fun to sort of think about some of these big picture topics that we've discussed here today. Take care, everyone.
Absolutely.
Talk to you. See you next week.